Here is the story everybody wants us to believe. Bitcoin goes through the cycles, drops by 70 or 80% in a bear market to then subsequently recover and make multiple X returns. But how consistent is that pattern actually? Let's have a look at the data in much more detail than most people discuss it. What we've got at the top, that's the Bitcoin price. What we've got at the bottom, that's its drop from its all-time high. So how much did we actually fall when we went through a bear market? From 2011 to 2019, bear markets were predictably 82% from the all-time high. That was every bear market up until 2019. But then 2022 was different. When Bitcoin bottomed out at roughly 16K, it did not fall by 82% from the all-time high. It already turned around at 76%. If you waited for the drop to 86%, you would have not taken advantage of those lower prices. So those kind of models are useful, but we can't take them too seriously. We can't take them deterministically. Now Bitcoin is cheap, now it's expensive, just binary 1 and 0. That's not how it works. There's many different influences on the Bitcoin price. And just because we fell by exactly 82% in prior bear markets doesn't mean that this has to happen in the future. Now, even if we assume that future bear markets will even be less severe than the past ones. So if we draw this line here, then still measured in US dollars, Bitcoin has not yet fallen all the way to its bear market bottom. We should be bottoming out somewhere around 69% from the all-time high. Now, where was the all-time high? Let's measure it. 69% from that all-time high would bring us to a Bitcoin price of $39,000. But again, while this price level might be a useful reference point, we don't know if we top out at 45K or at 35K or exactly at 39K. What seems to be a somewhat logical conclusion though from that all-time high analysis is that the bear market probably is not yet over. If we buy today and we hold for the next 5 years, probably the prices today are fine. But if we buy today with the intention to sell again in a few months, might still be a bit early. Now that's just by looking at Bitcoin's price in isolation. But no investment lives in isolation. There is, for example, the monetary debasement. So when we divide the Bitcoin price by USM2, the US money supply, we get a very similar chart, but it's not exactly the same. Still, the drop would be 69% from the all-time high. And even though the returns for Bitcoin are diminishing over time, from one cycle to the next, it still outperforms monetary debasement. This year is a time span of 4 years, and Bitcoin outperformed the debasement by 74%. Now, the US money supply grows by roughly 6.8% per annum, so this is on top of that inflation. Now, here's something that most people are not aware of. Most people think that they are spreading their risk, that they are diversifying by owning a lot of different cryptocurrencies or by owning a lot of different stocks. But really, diversification is achieved by owning different asset classes. As in, it's not necessarily true that Bitcoin goes up and then tech stocks go up as well, or that when gold goes up, tech stocks go up as well. The diversification is really achieved across asset classes, not within an asset class. Thus, we want to compare Bitcoin to competing asset classes to then figure out where should we have more allocation within the portfolio. And so here we've got the Bitcoin relative to the Nasdaq 100, relative to technology stocks. Again, we tended to see a very predictable pattern in bear markets. Relative to tech stocks, Bitcoin even fell by 84% in prior bear markets. 2019 was the turnaround, and we could make the argument that Bitcoin has already bottomed versus tech stocks. Now, how is that possible? How can we have already bottomed versus tech stocks, but versus the monetary base, we still might fall further? If we take both of those findings seriously, the only logical conclusion is that tech stocks might be crashing from here. Maybe they go down at the same pace as Bitcoin, but if Bitcoin is expected to go down versus fiat currencies, and it's not expected to go down versus tech stocks, then of course tech stocks should be falling. In other words, if we decide between Bitcoin and tech stocks, even though Bitcoin might still fall further, tech stocks are probably not the right alternative. So what about gold then? This is Bitcoin relative to gold. Let's have a look at the drop from the all-time high. Again, the same pattern. we tended to bottom out at very similar levels. Here it's 82% from the all-time high. And recently, every bear market drop tends to be slightly less severe. So it's not just the upside that diminishes over time, it's also the losses that get less amplified. But again, it looks like we might have already bottomed versus gold. So this would mean that both technology stocks and gold might be falling, and that Bitcoin is not expected to fall more than that, maybe even appreciate against the devaluation of tech stocks and gold. Now, how does this make sense? This entire cycle has been very unconventional because we saw both tech stocks, so risk on investments, and gold going up. Those two things shouldn't go up at the same time. Risk on and risk off should not appreciate at the same time. They should rather move in opposite directions. But that's not what we've seen in the last years. Thus, if we now see both going down at the same time, it should not necessarily surprise us, right? The common wisdom has already been falsified. This situation makes investing very hard because there's nothing that's clearly cheap. There seem to only be things that are already overvalued where currently the momentum turns negative. And so my personal solution is to get a bit more complex with my strategies, right? I do delta neutral trading. I bet on falling altcoins, for example, and on a rising Bitcoin price. Or I do interest rate arbitrage. I short the stocks on hyper liquid on other exchanges that currently have a very high funding rate, and then I buy the exact same stock in my brokerage account, earning the funding rate. So those kind of strategies are more complex. They can make a lot of money, but the most important thing is they're completely independent of the macro environment. We don't want to be too much exposed to the macro. If everything comes crashing down, we should still keep our purchasing power. Some people just diversify, they just own some gold, some stocks, some crypto, some property, etc. Maybe some unconventional investments like art or luxury cars. What I think is an important takeaway from all of this is that Bitcoin is not expensive anymore, relatively speaking. It has already dropped by 50%, and if we've got a long-term time horizon, we should be doing okay. Will it drop over the next months? Probably. That's my personal expectation. But again, it's just an expectation. I don't have a crystal ball either, right? It's simply just how I currently interpret the data points. I have built a cheat sheet on how to navigate the big picture. It's completely free. You can either get it via Telegram by scanning this QR code or by clicking this button over here. You can also get it via email. Just plug it in over here, click that button. There's no payment required. There's no credit card required. It's completely free. This website is linked down below in the pinned comment. If it's your first time here, feel free to subscribe. I publish here regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time. Cheers.